Hello, everyone. Welcome to our Q3 Asia Trade Floor update. I'm Jingjing Huang, credit product strategist. Joining me today is our Asia portfolio manager, Stephen Chang. Thanks for being here, Stephen.
Thanks, Jingjing. Great to be back.
So, Stephen, PIMCO recently published its latest secular outlook, Rupture and Resilience. What do you think is the most important message for investors?
The longer-term message is that we are operating in a world with a wider range of possible outcomes. That's the rupture part. But the near-term backdrop has also been more resilient than many expected. Growth has generally held up. Inflation pressures have moderated from earlier peaks, and central banks still have some room to respond if conditions weaken.
So that's a more uncertain world, but not necessarily weaker.
That's right. The world is still harder to forecast, but investors are starting from a better place in fixed income than they were a few years ago. Yields are meaningfully higher now, so income can do more of the work. In our view, investors no longer need to stretch as far for return as they did during the low yield period.
And what does that mean from a portfolio perspective?
It reinforces the case for resilience. High-quality fixed income can once again play a central role, providing income, diversification, and potential downside protection. And because outcomes are becoming more differentiated across countries and sectors, active management becomes more important.
Let's bring that down to the regional level. Let's talk about China. A lot of investors have been waiting for a shift towards consumption-led growth. Is that what we're seeing?
Not really at the moment. There is some policy intention to support consumption and household income, but the broader direction remains supply side. China is continuing to focus on productivity, technology, and industrial upgrading. This is less a new growth model and more an upgraded version of the existing one.
And why does that matter?
Because China continues to produce far more than it consumes. China accounts for roughly 30% of global manufacturing value add, but less than 15% of global consumption. That gap still matters for trade, supply chains, and global prices.
How does this change the investment case for China?
The investment case for China is becoming more selective. It's less about broad participation in a growth story and more about identifying areas aligned with policy's priorities. In credit, that also means being selective. A lot of China's AI infrastructure is supported by banks and state-owned enterprises, given abundant domestic liquidity. So we don't see AI as a broad credit opportunity in the same way it may appear in equity markets. We prefer to focus on issuer and sectors with strong liquidity, policy alignments, and clearer fundamentals.
China is obviously an important part of the emerging market universe. But stepping back, has the broader EM story changed as well?
I think it has. EM is still a yield story, but increasingly it's also a diversification story. Many emerging market economies enter this period with stronger policy credibility, more conservative balance sheets, and attractive real yields. One interesting point is that inflation across emerging markets, even excluding China, is now lower than US inflation for the first time in recorded history. That's a very different starting point from past cycles.
On the secular horizon, what does this mean for our EM outlook?
The same forces reshaping the global economy are creating different winners and losers across EM. Some benefit from commodity exposure, others from technology supply chains, and others from stronger policy frameworks. That means while it's reasonable to own EM broadly, it also pays to be selective across countries, currencies, and credit markets.
Thanks, Stephen. And thank you all for watching. For more details, please read our latest secular outlook.
Thanks, Jingjing, and thanks everyone for joining us.